This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
It is still the beginning of the year, so perhaps 2026 is the year that you have said, this is the year. I've had it with the man, or I've had it with having to run my business and all the responsibility that's involved there. I need some me time for myself, for my spouse, for my kids and grandkids. Okay, if that's the case, then consider yourself in the critical zone. So what I want to ask you about, Mr. Hicks, is the decisions and the moves somebody who wants to retire in 2026 should be making now, because the decisions you make now are going to determine how comfortable you'll be in the years ahead. We still got things like lingering inflation. We know about new tax laws are coming into fold. Rising Medicare costs are a real thing for all Americans. So what are the things that we need to be looking at if we want to make 2026 the year we retire?
I mean, if you're, let's say, 3 to 4 years away from retirement, 3 to 5 years, that is really the critical zone. So, when you think about this, it's kind of like what the New England Patriots were not able to do hardly at all during the Super Bowl, which is get in the red zone. I mean, those guys were really terrible when you really look at it in that last game. And that's the most critical part. But when you think about the critical zone, or basically what we would call the red zone, and in the concept of football, we want to make sure that we're making the really good decisions, because, believe it or not, bad decisions in this point, when you're that close to potentially able to score, and that example is like, when can you retire? Bad decisions can cost you, this is no joke, decades of comfort. Because if you get, and most people, though, they get paralysis of analysis, like, oh, John, but I know exactly what you're saying, man. If I make a bad decision, I'm going to blow it all up. I'm not going to be able to retire. Believe it or not, it's not the bad decisions. It's just consistently making not bad decisions, believe it or not, is where it comes down to. Because if you make a couple good decisions in those last couple years before you retire, you can literally set yourself up to get a paycheck. We're not going to be working anymore, so we're not going to have a paycheck going forward, but we can have a paycheck that comes from what? Social Security, if we have some form of pension, if we've got rental properties, or we can start taking income from our saved assets. But it is a really big deal. If you do that incorrectly or take too much in the beginning, you can unfortunately run out of money in the long run. So there's 4 major things I want to talk about today that we can be doing right now, because it's still early in the year. There's still a whole year to unwind. Of course, this is going to be a political year because it's a midterm election year. We don't know what that's going to do. But right now we do know, whether it's good or bad information, whenever the president gets up and says something, the markets move. So we're going to see a lot of volatility. I've said that. I said that from Trump 1.0 in his first term. And then we now are seeing that volatility again in Trump 2.0. It doesn't necessarily matter what the long-term game is. The short-term game with our current president, unfortunately, is volatility. And that can make us, unfortunately, do some pretty bad things when it comes to financial decision-making. So let's talk about it real quick. If you're going to retire within the next 3 to 5 years, we need to shift a little bit of our paradigm of thought away from just growing the money. Yes, we want it to grow, but we really need to shift it a little bit more from growth to producing an income for us, right? Interest rates, at least at the moment, are still fairly high compared to the last 10 or 15 years. So there are still many ways that we can get an attractive income stream from a lot of these investments. And we want to make sure that we're taking advantage of that. My guess is, and if the president gets his way, the new Fed chief may start decreasing interest rates, and which means we're not going to be paid as much on those fixed income assets. So one of the things we want to look at is, how can we create, it's almost like a retirement checkbook. We want stuff to be able to go into that account so it can start spending money off to us. Even if we're not ready to retire yet, we still want to set these things up so they can start creating that income, and we can stockpile some of that. So when we do have income needs, when we finally retire, it's sitting there and ready for us. So shifting from growth only into income planning is unbelievably important. And frankly, at the beginning of the year, it's a really good time to think about that. You can look at last year. Did you have some really big winners? Should you shave off some of those positions and put it in something that's still earning a really great rate and safer rate of return? That may be a good thing to consider. Maybe you've realized, oh my gosh, of all the things in my portfolio that went up, almost all the technology did. Now, here in this last couple of weeks, technology has taken a couple, heavyweight slugs in the face. So the question is this a good time to maybe diversify, take some of those great profits, lock them in, and maybe get something that produces an income. Those are really good things to do at the beginning of a year, and it also may help you with your taxes. So that's number one.
Okay.
Secondly, we want to really consider, a lot of people in their portfolios, they use a portion of their portfolio to be like an emergency fund. And the thing that I don't love about that term, it's great if you're only going to use it for emergencies. I really want to kind of consider it more like a war chest, if you will, Heather, because there's all kinds of times I'm talking to folks and they're just like, well, John, we don't want to dip into that. That's our emergency fund. Even if they're in a situation that's a little bit of a pseudo emergency,
right? Like
the hot water heater just went out at the same time that they just had to put a roof on, and they found out that they got to help their grandkid with a car,
right?
All of it once. And well, that's what it's for. So
right.
Instead,
that's exactly what we're talking about.
But instead of it being a true emergency, I really want people to think about it. Okay, let's just put this away in our war chest. Okay. And when they think about it that way, something changes. Something in their mind changed a little bit. They're like, oh, you're right. That's why we've been putting this away, because the word emergency isn't in the title. To think that, they're going to dip into the war chest. Why? Because they were wise. They were smart. They set that money away for a reason. And now a great reason to use it is coming into play. Right. Okay. So if we look at it not as emergency fund, but a war chest, that is a great thing to have working on all 8 to 12 cylinders as we're going into retirement. Right? We really want the opportunity to say, okay, if things go wrong, I've got 2 or 3 years worth of cash available, or short term and highly liquid and safe assets that I can pull from to live off of when the markets go up and down. Right? Okay. So a war chest is something great to consider, especially because a lot of the gurus out there are saying that this could potentially end up being a down year. We don't know. No one has a clue. No one has an idea, but the markets are showing some signs of a little bit of stress, a little bit of strain. And so to think about creating a war chest is probably genius. Okay. The 2 last things I'm going to hit: healthcare costs, guys. Healthcare costs are spiraling out of control. They've been doing it for quite some time. Yep. They're getting worse. Every time I look at something, I'm very reluctant to talk to people about what those real costs are going to be in retirement when it comes to healthcare, because it's something we can't control other than just to try to be healthy. But when you're looking at it, a couple that is 65 years old today, they are expected to have anywhere between $280,000 to $400,000 over the course of their retirement of health-related expenditures. Guys, think about that. $200,000 to $400,000 of healthcare expenses out of pocket. That's after Medicare has picked up their share or private pay insurance. That is astronomical. And that's not necessarily including long-term care for everyone. So we have to make certain that we understand. I personally do not love long-term care insurance. I think it's very expensive. I think that a lot of people, if they've saved well and have a good plan, can self-insure as long as they do it correctly. So I do not love the insurance. But having said that, I have seen healthcare costs blow up otherwise great retirement plans because no one saw it coming. It came at the wrong time. It came within a few years of that golden time period when they're in the red zone. And unfortunately, they blow through their money. I mean, this actually happened to my parents, where my father had a stroke before he retired. Unfortunately, my mother had to go through $500,000 of his savings to basically just pay for in-home care for them. And that kind of gutted a lot of their retirement money. So we want to make sure that we're understanding it's a good time of the year. Just kind of look at it. How are you feeling? Do we need to get to the gym a little bit? Do we just want to go get a walking buddy to get in better health? But it's really the cost and why we want to figure that out really as quickly as we can if you haven't done that. Okay. And lastly, we want to be flexible. We do not know what the administration is going to throw at us. We don't know what wars are going to be impacted, geopolitically all over the world. Things are not horrible. As a matter of fact, most of the numbers look pretty good. But it's just one of those things where people are just waiting for a shoe to drop, the next shoe to drop. So we want to make sure that your plans are always flexible. In our office, we say that they're living and breathing plans. As your life changes or needs develop, we want to make sure that we're paying attention to that. Does that mean we're going to tweak the plan a little bit? Of course, but it's only for the betterment of that client. So make sure that you're not establishing anything too rigid. Make sure you have flexibility. If there's an opportunity, that gives you the chance to jump on that opportunity to take advantage of it, either for more safety or more growth. But those are the big 4 things to think about as we're kind of going into this beginning part of the year before the midterm election stuff all breaks out and who knows what will happen. It's a great time to plan and use the beginning part of this year to get us in the right mindset.
What in the heck is happening with gold and silver? And
I don't know. Hopefully not the same thing that happened to frankincense and myrrh. I don't know. We don't know. All of a sudden, they just quit using that stuff.
No.
I don't know what had happened.
We want to know what's going on with gold and silver. And more importantly, we want to know how it relates, what's at the bottom line, right? How does it affect me? What does it mean for me, my savings, my future? This is what we're going to ask you. Jon Hicks, financial advisor, founder of J. Hagan Capital. I'm Heather Branch here with Jon to ask him about all these headlines we've been seeing lately when it comes to gold and silver in particular. I guess different alternative assets kind of come in and out of fashion, and gold and silver are the hot button right now. RetirementSolutionsShow.com is our website where you can go to start the conversation. Again, about you. That's what really matters here, how you deal with all of this stuff, all the different various headlines and how it applies to your plan for the road ahead. We've also have links posted in the show notes for you to connect to Jon and his team at J. Hagan Capital. So we've seen wild swings in gold and silver prices. I guess traditionally they kind of work like bonds do with the market when gold and silver goes up when the market is down, but lately that hasn't been the case. Gold dealer Max Baker tells Fox Business we're just another shocking global event away from prices heading much higher. This is what he said.
If we get some kind of credit event, think 2023 bank crisis, think another war, something with Iran, something with China, you could see silver at $200 in a heartbeat. You could see gold at, 8,500 to 9,000 in a heartbeat. Just, and that's looking at history. That's not just pie in the sky.
Well, I don't like anything that he was just saying, Jon.
No, that's not good at all.
How dare you? All of those things that could happen, Mr. Baker. You shut your mouth when you're talking to me.
He seems like a glass half empty type of guy, doesn't he? I know. No, but I mean, what he's talking about, there's a lot of truth to what he's saying, right? Okay. So historically, gold and silver, a lot of commodities have been used as a cushion or a safeguard against American equities. It used to work. I'm not going to say it was inversely correlated, but usually if the market was, falling off a cliff, it was crashing, then gold and bonds and silver would do a little bit better. Now, what we've seen recently, though, is there is a tremendous amount of speculation in precious metals, a ton. As a matter of fact, if you're watching any of the financial stations on television, my guess is in any given hour, there are 2, if not 6 different commercials for some guy trying to hawk you, gold and silver reserves and keep it in their, vaults or whatever, nonstop. So the thing of it is that, and we, in our office, we call them gold bugs. There's a lot of gold bugs out there. And to be honest with you, gold has done really well over the past, 7 or 8 years. It's done exceedingly well. So it's hard for someone that has had that gold bug itch. It's like, I'm just fearful, Jon, everything's going to fall apart. Let's put all of our money in gold and silver. Well, what we've seen is a ton of people have done that speculatively, and now the prices of gold and silver have kind of gone through the roof, realistically.
Okay.
So we're going to see a lot more volatility in gold and silver. And the question is this. The question comes down to, if we want ways to protect our savings, why would we go to another volatile asset like gold or silver or things like that, right? So the question would be, if we want to protect ourselves from a major downturn, why do we want something that can also go down at the same time? The correlation isn't as strong as it used to be. And correlation means when something goes up, something else typically goes down. Or when something goes up, the other thing also goes up. That's correlation, where you can see the trends and they'll go one direction or the other. What we're seeing now is that almost all of the gold and silver plays are a little bit like cryptocurrency. So all of a sudden we're seeing everything where people were fearful. All of a sudden there's just massive sell-offs, which can cause you to lose a fortune. And if you don't believe me, talk to any of your friends who owned a bunch of cryptocurrency. In the past several weeks, we have watched Bitcoin, and we do not subscribe to invest in Bitcoin, but I know people that do, and they talk about it all the time. It was over $100,000 a share, I guess, or whatever they call it, or a unit, if you will, Heather. It's dropped to below $60,000 per share. So people have lost 40 to 50% of their money in Bitcoin just in the last several weeks. But the reason I heard everyone wanting to invest it in the front end, if you recall, because it's very different in the U.S. economy. It's very different than the stock market. We're using it as a safety valve, if you will. Well, that safety valve has cost a lot of people a fortune, if you will. So the thing to understand from all this gold and silver talk, do I think that gold is a good investment? I do. For 3 to 5% of your portfolio. We never, ever, ever, ever want to look at a precious metal as truly an investment that we can live off of in retirement. And Heather, if you think about it, why is that? So because someone would say, well, John, my gold portfolio was at 42% last year.
Right.
Very true. But now that you have that 42% extra, how do you get income from that? Well, most people, it doesn't produce a dividend. Gold doesn't pay you a dividend. So they're going to have to sell some of that gold in order to take the profits to turn into income, right? Well, that sounds to me like what you're doing is you're buying high and selling hopefully higher. And that makes me kind of nervous. So when we're talking about income that we can live off of and rely on, we want it to be producing its own income. Like what? Well, Social Security. If we paid into Social Security, it's a social program, but if we paid into it, then at some point in time, this is going to start giving us a paycheck, right? For whenever we turn on Social Security, we're going to get that paycheck. If we own a dividend-paying stock, we bought, let's say, Procter & Gamble, just making one up. And Procter & Gamble, let's say, pays a 2% dividend. Well, whether or not we sell that Procter & Gamble stock, we're still going to be getting that 2% annual dividend. We can spend that. We can do what we want. If we put our money in the bank, we can typically spend that bank interest and not deplete our principal. Those are the things. Oh, and especially if you own real estate. So you bought a single family home and you're renting it out and you spend $100,000 on that property, but it's giving you $1,000 every month. You don't have to sell that property to be making that $12,000 a year. It just happens. So when it comes to retirement income, we want things that automatically generate the income. We don't want to think that we have to sell assets in order to produce an income stream. And that's why I don't like too much of a concentration in precious metals, especially gold and silver, going into retirement. 3 to 5% is great. If you are really, really, really jazzed about the idea that the market could plummet and you think gold's going to be good, maybe you could go up to 10 to 15% of a portfolio, but any more than that would be unwise. And the main reason for it is if you look over the past 100 years, gold has averaged around 5 to 5.5% of actual growth. The U.S. stock market has done much better. And of course, we know the markets go up. The markets can also go down, but including those ups and downs, the broad market has done a lot better than gold. And right now, gold's just very expensive. So the thing to think about when you're looking at all this gold and silver stuff is, do you own it already? How much have you gone up? Should you pare back that position a little bit, right? And maybe buy some things that are on sale now, or you can lock those into a guaranteed savings account at the bank or something like that. Or you could consider doing what I mentioned earlier and to put those assets in something that's going to truly spin off an income that's going to be consistent and usable. If you do those things, that's like a way to kind of win in the long run with what maybe, in my opinion, maybe a little bit of luck on the fact that gold's gone up.
Obviously, the idea of an alternative investment, I mean, correct me if I'm wrong, gold and silver, precious metals, that's the idea behind them, right? It's something that's not a stock, but it's still an investable asset. So if you think we need to proceed with caution, particularly when it comes to our retirement savings with gold and silver, but we do want alternate options, then what should we consider? What can we be looking at?
Well, there's all kinds of things. It depends on if we want to err on, or if we want to gravitate to the side of more safety, or if we want to go to a side of just not as correlated to only U.S. equity stocks, right? I mean, if you look at the broad stock market, the S&P 500, really, it's only about 25 companies that did really, really well last year. 25. The rest of them were either okay. Or not very good at all. As a matter of fact, in 2025, which was a good year for the markets, it was up over 16%. 190 companies were down last year of all those S&P 500. So the point is that if you just don't want as much correlation, you can consider those assets. But other alternatives, real estate, very attractive. There are all kinds of liquid alternatives now. You can consider the usage of annuities if you wanted to. Why would I say that? Well, because if we're thinking about retirement income, and if you want to be certain that you can't run out of money and you're looking for something to safely protect your income and your future asset, annuities are something that can consider that. Now, they're also very polarizing. There's a lot of people out there saying annuities are the worst thing on the planet. There's other people that say the best things in the world. I don't agree with either side of that. Those are very polarizing. But if we're looking at something that can completely protect your downside against loss, they're exceedingly less expensive to own because many of them you don't even have to pay to own an annuity type structure or even some secured notes. You don't have to pay for that as an advisory fee. So they can be very attractive to buffer the downside of a market. And the good news is that just like bank CDs, you can find them attached to interest rates that are still very elevated. You still may be able to get a completely safe asset class that can get you 4, 5, 6, 7, even 8% a year of secured income that you can spend. Now, all annuities are different. This is not saying one's better than another. This is why you always want to sound off with a skilled fiduciary-based advisor who can find out, because for some people, annuities are horrible. They would be terrible fits for their portfolio. For others, it may even be substantially better than some of the gold or silver that they currently own, or for divesting of real estate, right?
Okay.
So, but there's a lot of considerations. What's your tax situation? Is the money taxable, tax deferred, or tax free?
Mm-hmm.
Those do matter in that situation overall. But as far as alternatives go, we're going to see, especially over the next couple years, we're going to see a lot more alternatives like precious art, like works of art are now being auctioned. There's all kinds of stuff that they're now trying to bring to market. Some of it could be very attractive, but some of it's just sexy, but it's not going to, in the long run, be very good for investors.
Right.
So you just want to make sure that everything you own in your portfolio, you want to know the why.
Okay.
Why do you own it? What's its purpose? And for me, the closer we get to retirement, I want that purpose to be to safeguard a portion of my assets and to give me a spendable income stream. The closer it gets to achieving those two, the better off it is to have in your overall portfolio. And frankly, diversification kind of works on its own as long as you own, 10 to 15 different types of things over the course of all of your investments, whether they be CDs or money markets and stocks and exchange traded funds and real estate and gold. All those things can play a small part of a portfolio. You just want to make sure the lion's share has some form of protection and can give you an income stream.
All right. So I don't even know where to begin other than to let's just rip the Band-Aid off and say Elon Musk is saying we don't have to worry about saving for retirement anymore, John. So should we just go ahead and power down this?
Did he say that for all of us, or is that him? Because the last time I checked, he's going to get like a $1 trillion whatever stock grant from Tesla stock. So all of us. He, on the other hand, does not have to worry about retirement. He does not. But was he actually implying to us that we don't need to think about
That's retirement? Right. Ladies and gentlemen, pull your chair up close to the radio speaker because
we may have to unpack this one.
Let's break this down a little bit.
Yeah.
All right. So Elon Musk, you may have heard of a guy named Elon Musk.
Only in legend and lore.
He was recently on the Moonshots podcast, which is apparently a podcast about tech.
That sounds about right.
Right.
That sounds about right.
It's all coming together.
Moonshots. He'd do shots on the moon. He'll do shots anywhere. It's all good.
Moonshots podcast.
I got it.
It's apparently about tech. Regardless, he was talking with these guys and saying that between AI, robotics, and energy advances, these things will create so much economic abundance that saving for retirement will no longer matter. This is part of that conversation. Here's Elon Musk.
Well, one side recommendation I have is don't worry about squirreling money away for retirement in 10 or 20 years. It won't matter. You won't need to save for retirement. If any of the things that we've said are true, saving for retirement will be irrelevant.
Services will be there to support you. You'll have the home, you'll have the healthcare, you'll have the entertainment.
The way this unfolds is fundamentally impossible to predict because of self-improvement of the AI and the accelerating timeline.
In 10 to 20 years. He's not saying in another generation or two. He's saying in 10 or 20 years, you won't have to worry about saving for retirement anymore.
I am very confused though. So when I think about that, I was like, okay, so I'm gonna put myself
You're not the only one.
Elon Musk lens here.
Yeah.
So he's basically saying because of the advantages of artificial intelligence and robotics and energy usage, we are going to have so much abundance just as an average layperson who may not own or use any AI stuff and or have robots in our home. And maybe we have just a cardboard box down by the river, so we don't even have a big LG&E bill. He's saying that because of all that abundance, we're not going to have to worry about retirement because those things will be provided.
The AI is going to be paying us because it will become so efficient in systems. Listen, you're asking me, Heather Branch, nowhere near Jon Hicks' level of intelligence. So if you're confused, don't look at me for answers on this.
Well, here's where I go with this. And sometimes this happens all the time, right? So you get someone that is considered, one of the most genius minds of their time period or their generation or their era. And they will say some things that we just assume, oh, well, this guy's a genius. He has to get it right. But they don't get it right, okay? Because what this sounds like to me, this is like saying, I'm going to bank my future on AI fixing everything. This is kind of like saying I'm going to quit paying my mortgage because someday we're going to colonize Mars. And because we're going to colonize Mars, I know that this is going to work, so I'm just going to quit paying my mortgage, is what it kind of sounds like to me.
Yeah.
So I do agree with some of what he said. which is that I think that we will have a lot of abundance when it comes to how we've been so unbelievably inefficient on how we create energy as the human race. We're just very bad about it, right? When you look at what it costs to dig oil wells and to go get that oil and to refine it and turn that into a combustion liquid so that we can run our automobiles, it is unbelievably inefficient, but it's what we have. And Elon, of all people, he knows, he invented Tesla or came up with the concept of Tesla, and those cars are exceptional, except for the fact that there is not enough energy in our grid in America for even a third of the population to all drive Teslas. We wouldn't have enough juice to charge them up every night. So again, when I hear someone that is considered a genius thinker talk about things like this, we're missing something, or he hasn't put something together for us to utilize. Because I think it's the other way around. I think that all of this AI is just going to have us last longer. So we have more longevity to worry about. And frankly, that makes me more nervous because all of these things, we might be able to live. And I think that there was a conversation we had several months ago where President Xi of China was talking to Putin, not together, they were having it translated, but they were talking about how they expected to live to potentially be 150 years old.
Which is its own conversation, because I have no interest in living to 150 years old.
I think it sounds miserable.
Right.
I think it sounds terrible.
Everything is going to hurt. I will have no hair left. It's like a whole thing. Like, no thanks. I'm set on the 150.
All of my hair is going to be in my ears and nostrils and just everywhere except where you would want it, right?
I know.
Yeah, it's not a good thing. My eyebrows would be crazy. Yeah. So I don't think that would be a good thing. But I just think that this is one of those things that's a little bit lost. So here's what I think is going to happen.
Okay.
Technological advancements are incredible. They will help a lot of how we live our lives. But I frankly think that things are going to be more expensive. It may be a little less expensive if we actually do harness some ways that we're now figuring out how to utilize. And I know I'm going to get it wrong, but it's either nuclear fission or fusion or whatever it is to create unbelievable sources of energy that are very inexpensive.
Yeah.
We're on the cusp, let's say the next 20 to 50 years of maybe figuring that stuff out.
Yeah.
But still, though, we still have to get up, find a way to get our electricity on. And let's say that that's taken care of. But then how are we going to get to work? What jobs are we actually doing? Are we working for the AI? Who's going to pay us? Right. So when I hear the comments that Musk made, I just don't know if I understand it. So the biggest thing that I want to make certain that we all understand, though, is that when you read these things, when you hear these things, for a lot of folks out there, they use this as an excuse to procrastinate more. It's like, oh man, if we're not going to have to worry about saving for retirement because everyone's going to be in abundance, man, I am not going to save a penny. The other way around, that's what I think is going to happen. I think things are going to cost a lot more because I think that a lot of the current systems we have, they're already being very highly, I'm going to use the word taxed. There's a lot of stress on the current systems.
Yeah.
So when I hear an Elon Musk say, oh, things are going to be so rosy in the future, it's kind of like right before the dot-com bust in the late 1990s, where they're saying, hey, the internet is going to mow your grass, it's going to fix you dinner, it's going to do all these things. And here we are, 25 years past 1999. I still have to cook my own dinner.
Yep.
I still have to put on my own pants one leg at a time. I tried to do two the other day at the same time. It did not work for me. I was on the ground.
Is that why your face is
really
black and blue a little bit?
We don't talk about that over here. Yeah, no, but so all these things, they're not a pipe dream.
Yeah.
They are very awesome ideas. It's kind of like watching a Steven Spielberg movie, right?
Yeah.
So, but unfortunately, I think the ending is going to be a little different. Yeah. So I'm looking very much forward to seeing how AI unfolds, how it makes our life a little bit easier. That would be nice. But at the same time, what are the jobs that are going to be left for us mere mortals? All of us, right? Mm-hmm. They say that AI can do all this tax planning now. They say that AI can select all the stocks. They say that AI can eliminate almost 90% of jobs in cubicles. Well, heck, then who's going to be around that even still has a job if we go that direction, right?
Okay.
So, Heather, my whole point is I take it with a grain of salt.
Sure.
Whenever I hear stuff that Elon Musk says, because I think he sees something. The question is it really what the rest of us are going to experience? And when you're worth potentially $1 trillion or close to it,
your perspective is a little different.
I think he may be in a little bit of a bubble. At least it's a different bubble than the one I'm in. right? He may be in an actual bubble that can float itself to Mars, and I'm more like a bubblicious or a Hubba Bubba style bubble. If you've chewed it for more than 15 minutes, it doesn't even have any flavor anymore. It'll still make the bubble, but it's not exactly what we were anticipating, right? So that's kind of my thought on that.
I will also say, I do feel like, okay, Elon, you're so brilliant. You see obviously he sees something, but it sounds to me like you skipped a lot of the in-between of how we're getting from where we are today to that point where we don't have to worry about saving for retirement anymore. So the in-between phase is where we need to focus on and find opportunity, because I'm not a naysayer on AI. I think AI is amazing. I think that it was going to do a lot of great things for us as a society. I don't believe in being afraid of it. I'm not a naysayer. I don't think anybody should be a naysayer. I think you should embrace it. The change is here. So maybe that's then the conversation for you, Jon, as far as folks listening to you on WHAS today, wanting to know how AI does play into the retirement plan and how to embrace it rather than fear it or reject it.
Yeah, absolutely. And at the end of the day, I just think that anyone that thinks that AI is going to solve everything, they're waiting on a miracle. But there's one thing I know for a fact.
Yeah.
When people are waiting for a miracle, they don't sleep well at night.
Right.
The people that know that their plan will work and they're not relying on a miracle, those are the people that sleep really well, because they know they're not expecting everything to be unbelievably rosy. They're expecting bumps in the road. And because they're expecting the bumps, it doesn't freak them out when they come along, right?
Okay.
So a well-crafted plan should take advantage of what we know today. We've been in roughly a 12-year market run-up. This is the longest-lasting bull market in the history of this country. Mm-hmm. If you're retiring potentially in the beginning part of this year, congratulations. You potentially have had the best market in the history of anyone to retire. That's something really good to think about. Part number 2, can it last this way indefinitely? I think absolutely not. So the things that I would want to do is to control, if we're potentially at this point now, how can we lock in some of those major wins, right? AI is not going to do that for us.
Right.
We can do that, but we have to understand where we start. If you do not have a skilled plan written by a fiduciary-based advisor, I would at least get a second opinion and find out what did they know that you may not be applying, right? Okay. And it's not one size fits all. Not every advisor is right for everyone. But the real question is, how can you use AI to harness the good pieces and keep you out of the trouble spots? Yep. That's where I think that AI can be good. And just really in general, what can we do right now to put ourselves in a better position? Because I know if we want to be able to sleep at night, we have to plan on the plan, not going to plan sometimes.
Got it.
And that's where I think that we have some work to do, all of us, regardless of AI.
Got it. What's grocery shopping day at your house?
Whenever no one else is at the grocery. So, yeah. So
are you guys like us? I swear I'm at the grocery store 4 times a week, and I try not to be. I don't like going there.
So what we have found is, because we have 2 small people that live in our home, and they have various practices in the evenings, we find ourselves on the other side of town. We have an hour-and-a-half soccer practice to wait through. So that's when we'll typically go. So we're at one of the Krogers or the Sam's Club or the Costco on the other side of town. There's nothing else to do.
You're like, it's here. Let's go.
And since it's usually in the evening, 6:30 or 7 o'clock at night, there's almost no one in there. I was about to say,
that's a lovely time to go.
We get very lucky. Yes. And it is awesome. I remember the last time, it's been a few weeks now. The last time when I went to Costco on a Saturday afternoon, I swore to myself,
never again.
I will get rid of my membership to ensure that I never make that mistake again before I'll go during that period of time. It's not a joke. Rough. I'm dead serious.
It's not for the faint of heart.
And here's the thing. I know that the people that work there are efficient. I know that what I get there is good quality. It's
not about that. It's about everybody else in the world being there and wandering around like
and of course
Disney
their
World.
Carts are the size of Volkswagen Beetles. So imagine everyone has got their own cart. Those people that you love, because it's me sometimes too, they got their hands propped over the thing, they're leaning
strolling
over, they're barely slumping, walking, and you're like, all I need are big baking potatoes and some bacon.
Bag of lemons.
That's it. 2 things. And then you realize that you've waited behind all these folks that are slumped over. We assume that they're fogging a mirror, like they're still alive as they're pacing down, only to find out that you have those 2 items. And then the line for the checkout is like 45 people deep, halfway through the back of the store before you can get into one of the checkout things. Yeah.
All right. So
anyway, Monday night around 7 o'clock, That's when we do those things now.
Costco shopping on a Saturday afternoon, or thinking that you can just run in for a bag of baked potatoes because it's nearby on a Saturday afternoon at Costco. Regrets, as
Those
you're pointed
regrets,
out,
for sure.
as you're pointed out by Jon Hicks. Everybody, stay away from the Costco at 2:00 on a Saturday. Hey, speaking of regrets and spending our money, let's talk about the work that you do, and to help us avoid. See, and this is a great point. You teach us about don't go to Costco at 2:00 on a Saturday. Don't make poor decisions when it comes to your income strategies for retirement. You've got a wealth of knowledge to share on all different aspects of life, Jon.
Absolutely.
Let's talk about this latter point. It brings me to a sad, at least an upsetting story, because there was this woman. I found this article online. A woman wrote into an advice column, and basically, long story short, she's going on the record saying waiting until 70 to take Social Security was the worst decision of her life.
Ooh.
Let's dig in. So now she's getting over $5,000 a month.
That doesn't sound bad.
That's right. And this is exactly her point that she's making. She's getting over $5,000 a month now. She would have gotten half of that had she filed at age 62.
Sure.
Which she points out, it looks great on paper, but the problem is that life is not lived in monthly installments. So she said, and I quote, "I spent years telling myself I was being responsible by waiting, watching friends travel and enjoying their early retirement while I kept working. Sure, my check is larger now, but at what cost? The money I'm finally receiving cannot buy back the health and energy I had in my 60s.
Isn't that unbelievable and so
breaking,
poignant? I love that line. She said, life isn't lived in monthly installments. The reason why that is such a good line is because I cannot tell you, Heather, how many people I run into over the course of a year.
Yeah.
And they are looking at their spreadsheets thinking that the spreadsheet is the game that they're trying to master.
Got it.
They think that that's the actual thing. Guys, the spreadsheet is a reflection or a representation of a part of your life.
Yeah.
Life is what we want to win. So in this example, and this is the craziest thing, but it's true. So she waited to age 70 to get the highest Social Security payment, only to find out, well, now she doesn't feel as good. She doesn't want to travel as much. All of her friends have already done all those things, and she unfortunately is miserable. This is almost exactly what happened to my parents. A little different. They weren't waiting on the biggest bucket from Social Security.
Yeah.
But when my dad decided he wanted to retire, he kept just pushing it off another year, pushing it off another year, pushing it off another year until he ended up having a stroke. And he was unable then at that point in time to actually travel and do things. So my mother was almost 9 years younger than my dad. When my dad had a stroke at age 69, my mom was only 61.
Yep.
And they were not able to travel at all. Why? Because he kept putting it off. He kept delaying retirement. So this is one of those situations where every single time I'm meeting with someone in the office, what I ask them is, the money will play itself out once we figure it out what you want it to achieve. What is it that you want to achieve? The money will play itself out once we figure out how to get you most efficiently to where you want to go. Because in my opinion, because of this lady's story of basically she's got a ton of income now, more than she would have had, but it's at a time when she can't even use it. It's not even fun to use it.
Right.
That's why I want most of my clients, people that come see us, I want you to understand, I want you to front load retirement. I want you to think about all of those great things that we fought for, we saved for, we gave up things for, so that when we did get closer to retirement, we thought or we think we can do some of these things. I want most of our clients to do that in the front end of the retirement for two reasons. And this lady's story is perfection, because that is the youngest that we're potentially going to be. And that is often the healthiest that we're going to be is in the beginning part of retirement. Now, why do most financial advisors not tell people to front load retirement? Because they're fearful that there won't be enough money because they're not very skilled at creating retirement portfolios. It's the truth.
I was about to say, is it that the type of advisor that does there's growth advisors and then there's retirement planners, and it's two very different specialties?
Unbelievably different ball game. So if someone says, John, I want to, I'm 40 years old, I want to go buy a yacht one day, chances are that is not my style clientele, because that is important to them, but that is not important to me. To me and to my staff and all the financial advisors, all the retirement planners in our office, what I want people to know is, hey, when you get to the point where you're thinking in the next 3 to 5 years, you may not want to work anymore, or you may not want to do that job anymore, or you may want to relocate, or you may want to downsize. And you really just want to figure out with what you've saved, can it do the things you need it to do so that you can be comfortable in retirement, right? Because there's all kinds of things. Can I protect what I got? Can I create an income stream I can live off of? Can I give the least amount legally allowed to the government for the IRS and pay the least amount in taxes? Well, if something happens to me, can I be certain that's going to go to my family and not to the government? And then how do I take care of healthcare costs? Those 5 major things are what we all want to figure out. So for me, my whole thing is like, well, how can I kick off retirement with a bang for these clients? How can I say, yeah, you thought you couldn't do that Mediterranean cruise. You absolutely can. And you can potentially do it in the first 18 months of retirement. We want to make sure we select the right one, the right time, the right thing, because we may not be able to do a ton of these, but let's get it right. Let's make sure that we're not doing it on the cheapest boat in the worst time of the year. Let's do it right and give you something to talk about. And to me, it's a psychological effect. Not only is it, I know that we can create the plan to accommodate that or a portion of it. The main thing is that I want something for those clients to talk about for the rest of their entire retirement. And if you think about that, you think back about, man, that one great time that you rented that lake house and the grandkids came down. You talk about it all the time for years and years and years and years. That joy, that opportunity is something that most people don't really think about until it's too late, right? So one of the things that my advisors do, because I've trained every single one of these guys the same way, I want them to understand, I want you to be the sounding board for finding out what are great decisions that those folks can make, but how can they spend their own money in a way that makes them feel great? Not just better, not just comfortable, but makes them feel great. Do they want to give more to the grandkids now? They got plenty of money. Why wouldn't they do it now? Why do they want to wait until they're gone?
Right.
Let's do their giving while they're living. Right. Instead of just going on a Mediterranean cruise for 2 people, maybe they rent a lake house for the whole summer. And because they've got 3 or 4 kids all spaced out. But that way, each one of those families can come and visit them for a couple weeks or however it works out. And you can see that family, but still get those opportunities. Those are great uses of money that you may not see in a spreadsheet. That spreadsheet is not going to show you all that joy and all that excitement and all that buildup and all those memories and stories you're going to have. But you can do that if you're speaking with a real advisor who understands that, right? For most people, when they're thinking about retirement, that's their first retirement. That's potentially their only retirement.
Right. Hopefully first and last.
Office, I mean, collectively, we've seen thousands of retirements. No joke, thousands of retirements where we're trying to look at how can this person go from point A to point B and enjoy it, right? It's not just about, hey, we can't do that or we shouldn't do that. It should be, we can do these things. Here's what we're trading off in order to be able to do those things, but we can absolutely do that. And those are the things that we want to put the most weight into anyway. So we tell a lot of clients all the time, don't get hung up in having the spreadsheet look the best. This is not about winning the spreadsheet game. It's about winning the life game, right? That's what we want to talk about. So much math is involved in what we do. But at the end of the day, I want the clients to be happy. I want them to know that this is what they put all of that work and blood and sweat and tears into. Let's make it the way you want it to be. This is the first opportunity many folks have to reinvent themselves, to use their time wisely. And if we do that well, it is truly a life well spent. So if you don't know what you want to do in retirement, that's fine. But speak it out, talk through it, or get a second opinion from a skilled fiduciary advisor who not only understands what it means to have a pile of money, but how can you live off of it to give you what you want so that you can harvest it for your needs first.
Let's begin the conversation helping you understand about your plan, your money, your future. It's retirementsolutionshow.com or just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.